The Federal Reserve is warning that inflation could be getting harder to beat, not easier. Fed officials are pointing to three forces pushing prices higher: tariffs, rising energy costs, and a surge in spending on artificial intelligence. Together, those pressures are complicating the central bank's effort to bring inflation back to its 2% target, and they signal the Fed is in no rush to cut interest rates. Start with tariffs. These are taxes on imported goods. When businesses pay more to bring in foreign products or parts, those costs typically flow through to consumers. Prices rise. That effect is direct and well understood. Energy costs work the same way, but broader. Energy feeds into the price of almost everything: manufacturing, shipping, food production, retail. When energy gets more expensive, price pressure spreads across the entire economy quickly. The AI angle is newer and worth paying attention to. A massive build-out of data centers, specialized computer chips, and power infrastructure is underway to support the growth of artificial intelligence. That build-out is generating enormous demand for materials, for labor, for electricity. When demand surges and supply chains strain to keep up, prices tend to rise. The Fed is treating AI investment as a genuine source of inflationary pressure, not just a technology story. For the central bank, the problem is that these three forces are hitting at the same time. The Fed's core job is to keep inflation near 2% over time. When multiple pressures are pushing prices up simultaneously, the argument for cutting rates gets weaker. Lower rates encourage more borrowing and spending, which can add fuel to an already warm inflation picture. The Fed is not going to cut into that. This matters for markets. When interest rates stay higher for longer, it tends to weigh on stock valuations, particularly for growth companies whose value depends on expectations far into the future. It also pushes Treasury yields higher. Any change in the Fed's tone on inflation sends ripple effects across stocks, bonds, and currencies. The broader context here is important. Inflation has fallen significantly from its post-pandemic highs, but that final stretch, getting from modestly above 2% all the way back to the target, has been the hardest part. The Fed's latest remarks suggest that stretch just got harder. Watch the upcoming inflation data releases closely. If the numbers confirm what Fed officials are flagging, renewed upward pressure on prices, expectations for rate cuts will get pushed out further. That shift in expectations, more than any single data point, is what tends to move markets. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.